Let's just say that again. The mother of all bull markets and treasuries. We're on the threshold. Fellow asset capitalists, I am, of course, Hugh Hendry. Hugh Hendry Official can be found on, heaven knows, I can be found on Instagram, YouTube. I can be found as Hugh_Hendry on Twitter. Send me love, send me disdain. Just don't ignore me. Today, I'm excited. We've got Alex, God knows, Gurevich. I'm going to call him Alex Greenwich Village. He looks like he's in Greenwich Village. And fellow capitalists, I'm going to try to make this show more about you. And so I know I'm verbose, and here I am being verbose. And I'm going to really try to make this more comprehensible, so that you can maybe get a sense of what we're talking about. But anyway, enough. Let's bring in Alex. Alex, how are you? And so nice to finally get a face-off with you.
Yes, thank you for having me. I feel like it's been very long in the making, that we've had to have had this conversation a while ago, and I'm glad that we're having it now.
Well, the best meals take a lot of preparation, and I hope we're going to serve a feast. Now, can you tell the folks, I mean, I know what you're all about, and lots of people know what you're all about, but for those who don't, what are you all about?
Well, I am a mathematician by background. I am an avid player of board games and reader of fantasy and science fiction. But probably the main theme for me being here is that I run a hedge fund. My background is I worked on Wall Street. I have a PhD in mathematics. Then I went to work on Wall Street. I worked in firms like Bankers Trust, which became Deutsche Bank, and Chase, which became JP Morgan Chase. And afterwards, started to run various ventures on my own, including my current hedge fund, Conte Investments, which has been going on for a few years. I also wrote a couple of investment books, The Next Perfect Trade and The Trades of March 2020. So that's probably the brief introduction.
Wow, I'm in the presence of a very industrious financial entrepreneur. I didn't realize you are running a hedge fund today.
Yes.
And we have to be very careful about talking about hedge funds on public platforms. But what kind of fund is that?
It's a global macro fund. It's basically the continuation of the strategy I developed starting about 20 years ago, working at JP Morgan and running a proprietary portfolio there. In 2002, I switched from running franchise books to running global macro portfolio there. And I developed a certain strategy that's been evolving over the last 20 years, and I'm still running it.
Yeah, I mean, do it and either fake it or do it until they find out. So perhaps we can proceed. Maybe I should be a prospective investor. And again, we have to make sure we don't compromise you. And we're not in the business of promoting. If any regulators watching, we're not promoting hedge funds, but we're just trying to get inside the mind, not of people who write theoretically, but those who actually risk capital. I think insights are to be found with those who have the sharp pen, the underwriter's pen, where they feel the pain when they're wrong and they feel the elation, the monetary elation, when they're, I mean, obviously you've got skin in the game and when it works. So maybe we'll pursue it that way. You said proprietary trading. So I'm now on the debunking, the demystifying of our very special trade, our arcane trade. Can you just maybe touch upon what you mean by proprietary?
Well, in the past, mostly before the Volcker rule was introduced and the changes happened, banks used to take some proprietary risk, which meant that they had some traders that would use banks' capital to try to generate extra revenues. It is very similar to kind of running internal hedge funds in the banks, though the structures are somewhat different. And I don't really want to, as you point out, talk a lot about internal structures at JP Morgan, but as a general rule, there were some people who had a good track record, who were allowed to run internal capital. It's not being done that much now, as far as I know, because the regulations about banks risking their capital have changed.
Mm. So as a risk taker, how are you confronting risk today? We all have our prejudice, our conceptions. Where on that board game, where are you? Where can we find you today in terms of your setup?
Are you asking me in terms of like general philosophy or specific themes, current themes?
I think we'll draw your philosophy to understand the man or the lady. Yeah. We got to look at where the risk is deployed, where the prejudices lie, and therein lies the philosophy.
Well, one of the things that I've discovered very early on working, when I started working on market making side, I dealt with a lot of illiquid transactions, which required a very patient approach. Working at JP Morgan, sometimes I had to do transactions of the size in the market that the whole market would not trade otherwise for a whole year. Like there would be a client deals of really large size that you had to warehouse. And warehousing risks, I learned about being patient and understanding interactions between asset classes. That kind of led me to the ideas of portfolio hedging and risk parity, even though I didn't know it was called risk parity in early 2000s. I didn't know that other people were doing risk parity, but that became kind of my way of thinking about the world, which was not necessarily for other people. Risk parity is stocks versus bonds, but for me, it's any pairs of asset classes which have negative correlation. So I started to think about how asset classes operate.
But again, for those listening, how would you attempt to separate the conventional, if you will, institutional stroke pension fund, which is typically structured along a 60%, 60-40 rule? God, now I'm exposed. I'm fatigued today. 60-40 means 60 in equities, I think, and 40 in bonds, or it's the reverse?
Yes.
60 in equities, yeah. So, and how would you separate that from risk parity? I mean, they're kind of just. But anyway, how would you?
There is a relation there, but there is a very fundamental philosophical difference between that type of portfolio allocation and risk parity. Because until people like myself and some people before me invented risk parity, the idea was that this is a trade-off. You can own certain amount of stocks, and whatever you don't have in stocks, you put in bonds or gold or cash. And this was like people were thinking, well, if I put a little more in bonds, it becomes a little more conservative. I sacrifice a little bit of a long-term returns, but get less volatile portfolio. Then risk parity, I honestly think that this was equivalent of theory of relativity in finance. It was probably one of the most important inventions in the history of finance, risk parity. And it defined the following 20 years of financial markets.
It was wonderfully that like everything in life, a lot depends on when you have that light bulb moment, yeah, and the conception of the risk parity. And I'm going to put words into your mouth, but I think one of the things you were telling us is that unlike the conventional 60-40, the approach of risk parity is firstly, it's more dynamic. There's more resetting in terms of allocations. And then you can either be static with regard to having, if you will, a permanent portfolio. And if we were to conceive of 4 quadrants, and I think you referenced that, stocks, cash, and so just now your cash would be doing well because there's a carry from our friends at the Federal Reserve. There's been no carry for the previous 10, 15 years. Then you might have your alternatives, and we might have gold, we might have private equity, we might have illiquids, and then you'd have treasuries. And you could just keep it like that. And indeed, for those listening at home, there's an ETF, the permanent portfolio. If I go like boom, I think we will superimpose the chart of that. And for little fee, that's one way for people sitting at home to kind of get that exposure. But I believe with your philosophy, You took that a step further and you dynamically change the allocations as volatility changes. And rather than having preset, it's allocated according to a constant volatility. Now, what I was saying about timing, when you started to allocate on the basis of the volatility of the asset class, of course, it allowed you to have a super large holding in treasuries. And if this was conceived of over 30 years ago, as treasuries emerged into this super bull market, then it has been a golden proposition. I'm saying too much. Tell me.
No, yes, you touched on the important thing here. And this is what I want to make, to take this. By the way, I am not the person who really adjusts by implied volatility and relocates things every day. I don't really believe in this. I believe I have my own system of how to balance portfolios, and I do it myself. But the point I'm trying to make is that, and you touched on this point, you actually don't have to sacrifice returns. The whole thing about risk parity, because if you run a leveraged portfolio which involves derivatives, in the past it was, the original thinking is I can be 100% stocks or sacrifice 40% stocks to have that in bonds, so to say, sacrifice, right? Now, if you have risk parity, you can have 100% on stocks overlaid with bond futures and actually have a safer portfolio. Then the next step is, because your portfolio is safe, as is bond futures hedge it, you can have 120% on stocks with leverage, or 150% on stocks, and 300% in bonds. And then you have a portfolio which has both sides which perform in the long run. And all you have to do is navigate the interim volatility, which is, of course, easier said than done.
Very much easier said than done. But again, so there'll be folks going, wow, this is interesting. But I think we have to take a step back, because there is a model that you're using to determine the leverage. And again, I would think that model. So if we went back, let's say 30 years, and I'm going to make these numbers up. It's for you to educate us. I want to say you could have gone back 30 years, and maybe the 10-year treasuries had a price volatility of between 6 and 8%. Is that too low?
You know what? I don't have this number from the top of my head, but it's probably the right amount.
6 to 8. Yeah. And then equities would have had a volatility approaching 15, between, let's call it 12 to 15%. Yeah. And then gold precious would have a volatility of, let's say, 10. And then you might decide that your overall portfolio you'd be targeting, again, let's say, a volatility of 10. And so with your futures, you would solve for that volatility, and then that from it, the variable or the residual output would be your leverage in the various lower volatile asset classes. Can you say that more smartly than I'm doing?
Well, let me say it not in terms of implied volatility, because what I found is that implied volatility and even realized volatility could be a little misguiding. Because what I found early on in my career, that I am a very comfortable long-term investor, that I can hold positions for a long time. So then for me, the important question is not how much the position can move in a day, because I never size in such a way that a daily move is a problem for me.
You've conceived of that. I mean, and that's my kind of investing. You're saying to me that having thought about it on an ex ante basis beforehand, before confronting the risk, you have defined in ordinary circumstances how much your portfolio might cost you, either on a daily. Could you just clarify how much of a drawdown are you willing to undertake before your head or your model says, I think we're wrong here?
Okay, well, this is going a little bit about specific risk management, and risk management, it has to be like kind of calibrated to. So there is a difference between position risk management and portfolio risk management, and I think sometimes people confuse it. Position risk management is about strategy. If you have individual position, you can have whatever strategy you want. You can say, I buy the stock at $100, I'm taking profits at 150 and stopping out at 80. Or you can have no stops. I'm buying the stock and holding it till I die, right? You could have, that is individual position risk management. Portfolio risk management is first and foremost about your portfolio size. If you're losing money, you have to shrink your positions because you have less money. Otherwise, you'll go to zero.
So but you were telling me that you're very reluctant to make interventions that, such as your risk constitution. My interpretation from what you were telling me is you're kind of willing. I mean, obviously, drawdowns, losing money is at least 50% of the time.
Well, yeah, drawdowns are part of our existence. We all have, and I think for my strategy, I tend to have protracted drawdowns because my themes are protracted. That's why when I look at positions, I don't think about what can I lose on a day. I think, what can I lose in a year? What is the worst case scenario for this position? And then I'm thinking, okay, can I tolerate this drawdown? I could look at stress tests. What are the, like if I had this portfolio like in 1987, in 2020, in whatever, most extreme market conditions. That's one way to look at it, think about it. On the most extreme market events, what could happen to my portfolio? And of course, history, it's always different. Every crisis is different. So texture of every new crisis is like, it's always something new. And sometimes you get, and honestly, it's about 50-50, whether the new crisis works for you, works against you.
I get that, but I'm going to keep pressing on this. So, because I know the models, and I'm just trying to shine greater light on the disciplines that both you and I have. I mean, you're still doing it. So you'll have a dashboard that will say on any normal day, you might expect that your portfolio would lose you how much?
Well, there are measures like value, bar, C bar, those risk measures, and they say like, okay, there is a certain amount, and I'm reluctant to give concrete numbers, but I'm just saying that because I run portfolios with different leverages and different situations. It depends on it's a preset. It could be calibrated to clients' leverage desire, or it could be calibrated for a particular portfolio. But you have a measure of what portfolio can lose on a regular bad day, which is usually VAR kind of as a regular bad day.
Okay, so you don't wish to put numbers on it. Yeah, you don't wish to put numbers on it. But okay, but let me, and forgive me, I'm interrupting. But I'm still curious because it was quite provocative. You're saying, I'm not someone that, I take drawdowns. I'm someone, I think you designed, I think the metaphor that I'd like to use is you're an architect, and that the individual risk positions can be these beautiful residential houses or a commercial property, but the portfolio is the city. It's the totality of all of that. And by any one day, things of course are changing, and it may be necessary to take down a building, but the city still remains, yeah. And so your inactivity is found at the city level, yeah.
I think that's an apt analogy. Sometimes the analogy I used in the past is like individual trades are like little farmers. You send them out, they're farming for you, and hopefully you get some harvest. And harvest might come a few years later. So you send farmers at different times, and you have different harvests of different goods at different seasons. That's the analogy I sometimes use. But I like your architect analogy as well. It's pretty good. Yes, individual positions sometimes can have to be thrown under the bus or taken down. Sometimes one of the psychologically difficult things is that you really love your position, but you want to liquidate it because there is actually an even better one out there. And that might be even in the case you love this position, it's underwater, it's losing money, you know that the position has great prospect of making money, but you have to take it down because you have to make a decision where you focus your risk. That's one of the hardest psychological decisions because you kind of want everything. You are attached to your buildings. You're like an architect, you love using your analogy. And if you have to demolish some of the buildings to build even a better one, that's always a tough emotional decision.
I mean, I always related it to they made a movie about the climber, the free climber. And I don't know how he managed, maybe he slipped, but he caught his arm in a crevice and he couldn't dislodge the arm.
Right.
And you only have two arms. And so it's a really hard decision. A life-saving decision is to cut the arm off, but you only have two. And so procrastinate. Yeah. And so I think what we find in portfolios like yours and the ones that I ran, that we'd have many arms. I would refer to the centipede. I'd have 100 arms or legs. And if I've got to chop one off, so be it. That one has to remain dying. Procrastination brings on suffering. Yeah.
Yes. And I can tell you from my personal experience, procrastination has not always been my friend.
Now, at the city level, am I right in saying you are running, if you will, quadrants of risk, which come, if you will, what would you call it? Neighborhoods which come together and form the portfolio. Yeah, but let's call it quadrants. Yeah.
I'm not sure. I think in terms of quadrants, though, like I am a kind of person who thinks of things like, okay, if you tell me how to allocate your portfolio without leverage, I would start thinking, yes, 20% this way, 20% this way, and I would kind of start thinking about quadrants of risk. In reality, I think more like I look for opportunities, I look for asset classes where I see long-term value. But then I try to see, okay, there is this trading opportunity within the realm of what I know about, which I look for things which have very high probability to work out on a horizon of 2 to 5 years. And it could be anything from very straightforward thing like being long stocks to very complex thing like some kind of asset swap or even some perf trade it could even look like a structured trade, but something I have high confidence will work out over a period of time. But then I start thinking, okay, I have this set of things that I like in the world. How do I choose the ones that I'm going to be in? And then when I choose the ones I want to, and how do I make it so that it's not like putting your eggs in one basket? So like if you say like, I'm going to be long gold and I'm going to long silver and I'm going to long platinum and I'm going to be long palladium and I'm going to be long Bitcoin, then you kind of put all your eggs in one basket, right? And sometimes that's the time. Sometimes you could be so convinced that you really overweight in certain direction. And I've done it many times. I'm doing it now, done it over years, sometimes like overweighing risk, where I really benefit more from one economic scenario rather than the other. I'm not like a totally market neutral, economic neutral person. But having said that, I still think about like, well, do I have something that will work if this will happen instead of this?
But so you have a hierarchy of risk and expected return, and that is how you choose between the stocks that go into the precious portfolio. But at the end of the day, it's still really a prejudice, and dare I say, a guesstimate in terms of the potential return. Can you maybe say something about how you try and make it less of a guesstimate in terms of you're using? I imagine you're using your expected return. You're using the expected journey. We talk about Sharpe ratios sometimes because some assets may offer quite a modest return from point A to point B, but it's quite a linear journey. And there may be other assets like our friends in crypto, etc., where the return might be 20x, 50x that, but the journey is rather sketchy. So again, could you maybe just this process of trying to, you found 5 assets, you really want to own all 5 assets, but you can only invest in 3 assets, and maybe just how the 2 that get the chop, how do they get the chop?
Yes, there is a hierarchy. I have an internal scoring system for trades. And then, but then there is I have a scoring system. I don't like open up how I do it publicly on a quantitative level, but on a qualitative level, in my first book, The Next Perfect Trade, I delineated how I rank trades, like what factors I look. So that's public information available to everybody. I look at things like what I like about trades. For example, I like trend, I look at carry, I like historical pattern. That is how this thing behaved in similar situations. I like it. I look at things like alignment with global growth and technological development. Then I looked whether trades are liquid, what are risk reward on the structures. There is a bunch of factors like this that I look at, and it allows me to create a semi-formal scoring system. But then it also matters, as I mentioned, that even if it's not just about trades with high scores, it's also how they balance each other. So that's more or less the way I would be thinking about them. And the quest is to get a portfolio with decent Sharpe ratio and get good long-term returns. And by now, I kind of know after last 25 years roughly what it is that I'm getting over a long time. It's fairly it's very volatile from year to year, but it's a fairly consistent over long periods of time, right? So I have some ideas. But I think one of the things is the holy grail is to not just give investors a good return, but give them something which is different from their other assets. So like now I pulled all these assets and I essentially created an asset for them, which is myself. It does not almost matter, it should not matter to them what's in my portfolio. The asset is Alex, right? What I'm running, right? And for myself too, that's how I would run my money, right? I'm having Alex manage my own money, right?
Yeah.
So I created this asset, but they now have to think how this asset that I created for them fits into their portfolio. Because if I'm doing the same thing as another hedge fund manager, only slightly worse, why would they want to invest in me?
They just want to invest in anyone who's making money. I mean, you could be with prostitutes, you could be sniffing cocaine. If you're making money, they're going to look the other way. But anyway.
Well, that's true. But making money, like there are some really successful hedge funds there, which have like this very long line of investors wanting to get in, right? People want to get in into some funds much more into the others. And if, for example, I say that I'm doing exactly the same strategy that another trader, and we're going to be very highly correlated, and we're going to be very highly correlated, but their Sharpe ratio is a little bit higher than mine, they will go to this other trader. Nobody will want to invest with me at all. Well, if they're rational, maybe like if they're my friends, drinking friends or something. I don't drink, but if I had drinking friends, maybe they'll want to invest with me. But otherwise, I see no particular reason for them to invest with me. But however, if I am doing something which, say you have a portfolio, right, which has even slightly higher Sharpe ratio than mine, right? But we do completely uncorrelated things, we're totally orthogonal. They might say, well, I'm going to give something to Hugh and something to Alex because between the two of them, I'm more diversified. So I think there is an extra advantage of creating something original for investors, which just doesn't act as other asset classes.
Indeed. And I'm trying to be the listener's friend and have fun. Orthogonal is one of my favorite words. I'm not quite sure. I'm definitely, well, my ambition was certainly to be orthogonal. But there's a lot of people who might go, WTF, what is orthogonal? So let me tell you my interpretation of that. If you think of a compass, northeast, southwest, and it's very much one-dimensional, being orthogonal is to introduce another dimension. we find another, where the compass leaps out. I'm sure you can do it much better than I.
Well, one of the ways to think about this is, for example, what does it mean to be orthogonal to stock market? It means to be uncorrelated. For if my investor looks at stock market, stock market was up 5% in the month of March. What is Alex doing? Now, I can assure you, based on this information alone, my investors have no idea whether I'm up or down money.
Yeah.
I mean, if I told them what my positions are, what my views are, then they will probably have some idea whether I'm up or down money. But if I didn't, based on this information alone, that will be very insufficient to know how am I doing. I could be flat, I could have a greatest month, I could have a terrible month, and that is important to understand. It's not a hedge. It's like when you are orthogonal, doesn't mean you're doing the opposite of other people. It means like you're doing something completely different. I also like to talk about the crowded trades. I like to say, like, sometimes like everybody believes in one thing and there's kind of a crowd, right, doing the same thing. And I always say, sometimes I'm against the crowd and making money and they're all losing money. Sometimes I'm against the crowd and they're all making money and I'm losing money. Sometimes I'm with the crowd, making money with the crowd or losing money with the crowd. I, in fact, don't care what the crowd is doing. I never cared what are the crowded trades, what are the people doing. I don't look very much at like stuff like flow information, because it's all, to me, that's all like putting it from one pocket to another. All people are buying it, and the next day they'll be selling it. So it doesn't really affect long-term performance on trades. So I'm completely not affected by if every hedge fund manager thinks the opposite of me, or if
Yeah.
every fund thinks the same.
Well, my fund was called Eclectica, pretty much for those reasons that you explained. Could you perhaps, several questions, but I'll try and aim one at a time on a linear progression. Outside the hedge fund, if we were just looking at Alex and his private portfolio, you're seeking to compound your returns at how much? What kind of? Are you a 10% guy? I think you're more like a 15% guy. More. I mean, what's your CAGR that you in your head if you were to define you?
I'd like to be a 20% guy.
Oh, you're so greedy.
But okay, that is not in any way a promised returns or even a statement about past returns.
Indeed.
I'm just like laughing at it because honestly, in my mind, I just want to make, to me, investment is something I enjoy. So I'm not, if I don't, I do it for so many years because I have a lot of fun with financial markets. I take it seriously. It's a passion. It's not a casual hobby. It's a passion for me, and I really enjoy investment process. And my goal is to just make as much money as I can. And it could vary. I had years which are close to flat. I had years that were really blockbuster, and I had years which are honestly pretty rough in my career. And a lot of it is public information. So
with the public information, tell when was your last really tough year? You know, anyone can make money, if you will. There's beta.
Last year. 2022 was the last really tough year. So because I really did not think the rates would go up so much, and I didn't have I was long duration the whole year because I was thinking I maintained a view that the rates will go to zero, and I was not really standing in front of every freight train, but I was on the wrong side of the market last year.
Yeah. So so thank you for sharing that, and my sympathies. Now earlier you mentioned that one of the characteristics that you build into your thought process and that you like, and I concur, is trend. Like, let's make this a simple business. We buy things going up, we sell things going down. Okay. But it's one thing to say trend. There's another thing to define the trend. Could you maybe flesh out trend? Is it a particular duration of trend? What has to happen to challenge the trend? You know, because we live in a dynamic, daily resetting world.
Well, one of the things I wrote about in the first chapter of my first book, which I wrote in 2014, it came out in 2015, The Next Perfect Trade, that there are different assets have different relations to trends. There are assets which tend to be trending, and there are assets which tend to be chopping. What the observation was that currency, for example, tend to form 2-3 year trends, which could be very useful. But on the long horizon, secular trends on currencies are harder to decipher. While, for example, interest rate markets tend to not trend on a short horizon as well. And actually, it makes sense to counter trade big moves on interest rate markets often. However, there could be really big secular trends. It's a very complicated subject. Honestly, I feel like there are some places where you can fish for trends, and there are some places where I just don't know how to decipher trends.
Can I ask you then, because let's keep it relevant. We've probably lost 80% of the viewers already. In the last half-hour section, so we've had a like a 40-year unbelievable, powerful positive price trend in the Treasuries. Last year there was a seismic shock to that trend. Is that trend still intact?
Well, technically, if you look at it from technical perspective, it is not. Because technically, the trend channel that I used to like most has broken down. Or it definitely went outside the channel, the 40-year channel, trend channel. So that is something to consider. To me, trend is one of the inputs, and trend input has become worse in 2022. The ranking of Treasury markets on that basis became worse.
I mean, I'm gonna go pop, and we'll get that 40-year, and we'll try and get the parameters. But for me, I thought it was just hanging on with its nails scraping down the wall, but like you say, really at the point where any further misdemeanors in terms of the price performance and the trend we'd have to take the trend out of the association with treasuries. But you think it's broken? Yeah,
I think it is technically broken, but in itself, the weighting for me of the trend being broken is very small. Well, it's not small, but it's just one of the inputs. So I don't ever think of like any technical factors as something. See, the best technical indicator in itself. See, when I always laugh when people say something. If this breaks this level, it's all over. Or, oh, we saw a reverse candle, now it's going down. To me, it's like, I would rephrase it like this. The trend broken, so now there is a 1% higher probability of it's going down than before it was broken. So every technical indicator, I think every single technical signal changes probabilities by about 1 or 2%. That's my guess. So like the odds, so whenever you have a strong technical signal, that means that there is 51 to 52% chance having no other information that you'll be right. No higher than that. It's like a blackjack signal. It's not like any kind of, I don't believe in any single. Now, if you have a lot of different signals, technical, fundamental, several different technical signals, they can adapt to higher edge. And the way I get edge by having signals aggregated from different areas, right? So, like, for example, the pattern signal, for example, here, let me give you an example here. Suppose, according to the chart that I looked in 2022, the roll-adjusted bond futures, roll-adjusted classic bond futures. That's my favorite chart. I call it the one chart over the year. I call it the one chart.
What is that? I mean, what is that, Alex? And is that
what would happen if you just buy bond futures 40 years ago and continuously roll them and hold them? Classic bond futures.
And how is
not that a yield chart, not a price chart? Just what happens if you buy and roll the economic result of buying bond futures?
Yeah, I mean, in an environment, in a 20-year environment, you might say, in an environment where the economy is not dysfunctional, you might anticipate that long-term rates should be constant. The risk factor would be constant. And therefore, you'd imagine that line would be, the price line would be flat, and then the gradient would be the carry.
Well, as it happened, because we went through 40 years of falling interest rates, there was a very strong uptrend. And honestly, when you see such a strong uptrend, it was very hard to maintain it. What was interesting is that I said something, I'll go back to one other thing I want to relate to it, but first, I said a thing a few years ago that I might have not listened to myself, my own wisdom, and that's one of the greatest problems of traders, not listening to your own wisdom. So for years, decades, I was observing this trend, and I said, uptrends, linear uptrends never break down. They first break up. And that's what happened in 2020, March 2020, it broke up. And then it broke down.
Yep.
So the breaking up in the spring of 2020 should have been a really good signal for the fact that it might afterwards break down.
Well, that's fascinating. I like that because I've contemplated something similar. Talk to me about, and I guess the reverse was 1982, and they didn't just go down; they really went down. When rates
yes, the Volcker shock and all this stuff, right? Yeah, so that's how things. Or if you think about, for example, the internet bubble, Nasdaq was going up and up, then it went really up at the end of '99, and that's when it set up for a breakdown.
Yeah, I mean, again, taking that further, for people just to think about, it's a double-edged sword. The best part, the real part where you make money, is when the price volatility accelerates as the price is trending higher, which was Nasdaq, which was Bitcoin, where you get 30 to 50% drawdowns, and you don't care. You buy the drawdown, or you allocate size whereby you run it, but it's and a signal of a long-term trend coming to its end is the fact that you have to own it, that it's very, very profitable, but that it's going to end, is going to end abruptly. And so that's your determination. So again, forgive me, I'm saying too much. Does that mean, am I to infer that you believe the high or the low yield for the 10, I'm saying 10-year, why not? Do you think the highs, the lows are in?
No.
Okay.
I actually think we're going much lower in yields. So what I think my current working hypothesis is that the bull market in treasuries, which lasted from whatever late 70s to
1982 to whenever, yeah, the last 40 years.
To 2020 ended, turned into bear market of 2020, 2022, and now at the beginning of the mother of all bull markets and treasuries. That is,
Okay,
it is just, I believe that the mother of all bull markets and treasuries is just beginning to wrap her eyes.
Let's just say that again. The mother of all bull markets and treasuries. We're on the threshold. So give us a little bit. So let's ditch the science and let's hear some. Let's hear your wisdom in terms of your understanding of why that happens.
I think to understand why I'm so convinced of this, I have to understand why I was wrong in 2001 and 2022 about rates going so high.
Okay, I would go quick on that bit longer on the next.
What is happening right now is the flip of what's happening in 2021 and 2022. Because in 2021, what I did not account for is how much inflation can create further inflation. If you have really high inflation and zero rates, it's not rocket science. You have negative 9% real interest rates in 2021. Even if that inflation shock was temporary, supply chain this, reopening that shock self-perpetuated and turned into a couple of years of really high inflation because people just had a lot of incentives to buy things, borrow money, because you're just getting paid to borrow money, right? So it's a really inflationary situation. But then what I think is happening right now, we have inflation rapidly coming down and rates rapidly rising. And that is becoming to be self-feeding and self-perpetuating process. And because normally in the past cycles and the situations, the Fed would be long easing interest rates, which by the way, they should be easing right now, not tightening, in my opinion. But because they're hell-bent to tighten, we have a situation in which we have falling inflation, dragging it even further, rates going even higher, money supplies keep tightening, and it's like rolling downhill and pushing an accelerator. That's what I'm seeing right now. And I think because they're so slow to react to, inflation is so lagging. If you think of a lagging inflation of 1 to 2 years, the inflation we're seeing now is a product of financial conditions of 2021, which were extremely profligate, right? We had fiscal expansion, we have crazy monetary policy, we had crazy inflation. Now, all of this is reverse. So personally, and this is of course speculative, that's my view, but I don't see why we should not have catastrophic deflation in 2024.
Okay. So I am uncomfortable in that I'm the inquisitor, but I'm very sympathetic to that point of view. But heavens, there are many people who would be pulling their hair out and saying, what are you talking about? Look at the employment figure. The economy is proving more than robust. Even the Fed is kind of, the Fed is still committed to raising rates. So what is it? What is the insight that allows you to be emphatic? The Fed should be cutting today. Why?
Well, I think the insight is the dynamic systems. And I'm sorry, I don't know how to say it without a little bit math on it. There are things which feed into themselves. Input, what I think the insight that people are missing is that inflation is an input into inflation. Current inflation is an input into future inflation. So high inflation led to high inflation, and now lower inflation will lead to lower inflation. And the key to everything is the policy lag. Everything that we do, everything that the Fed does only reflects on inflation like a year later. So everything that they did in 2022, we're not seeing it yet on inflation. What we're seeing now, inflation self-decelerating. And so the policy, if it were intelligent policy, should be not attuned to today's data. It should be attuned to the data we'll have 1 year from now. And with regards to employment, I will say, yes, of course, employment market is really strong. I could give you a long spiel about what I think about employment market. But if inflation is coming down when employment is strong, how horribly it will crash when employment will get weaker. That's my question. You see, all else being equal, we're seeing inflation spiraling down right now in every area. And there are some areas which are not recording it yet, like rental inflation. We know it's already negative, but it's still recording as positive. We know rents are down, but they're still recorded as high because of the lag. But so we're having inflation already coming down in the environment of strong job market. So that means that if that shoe drops, we're really going negative.
Well, so does that mean, because you might be the most charming man, because the thing that disturbs me about a lot of professional investors is how much time they spend reading and listening and discussing musings from the Federal Reserve. Are you the man that goes, I ain't listening to these bozos?
Well, I always like to say that you have to distinguish between what you think the Fed should do and what they actually will do, and not to be caught up on the first. The first is almost irrelevant.
Yeah. But
I think it's important to know, to have an idea whether they're going to do it the next meeting. I think anything past a clue what they're going to do, honestly, I consider everything coming from the Fed except a clue at what they're going to do at the next meeting is white noise.
Yeah. I mean, my view is I typically ask someone to tell me the last Fed intervention that was successful, that didn't have a violent shift to price volatility. And people struggle to answer that. So when the Fed is conducting a policy exercise, I think there's a lot of price history that reveals that there will be a disturbance to the price universe, that, volatility is coming back, that you're going to get quite a substantial price movement. And it sounds like you live in a very reflexive universe where you're seeing, second deviations and the like. And you don't really have to look out to the real world for confirmation. You're seeing the real world being processed via the quantitative factors that you are analyzing.
Well, you do have to, obviously you do have to look at the data. I just don't get too hung up on any particular data release. It's like a little stroke like if it's a painting, each data releases. For example, you see a strong report, employment report. People can say, well, seasonal factors this, seasonal factors that. It still adds a little brush stroke to the picture, right? Every CPI report. And of course, you always your portfolio manager, you always hope for the next number to be good for your portfolio, right? No matter what, you want to make money. No matter how long-term a thinker you are, you want to make money tomorrow, right? It's better than losing money, right, on any given day. You're always in a better mood when you have money. That's not something that's going to be changed. But what I think is I don't get too hung up on individual data, because I know that certain processes are in place, and it takes a lot to convince me that they're not in place. And sometimes I have to. I find that I was wrong. Like, for example, over the last couple of years, it's not that I was entirely wrong, but the dynamics I did not fully assess. I had certain ideas about what dynamics would develop once the Fed started to indicate that they're going to get aggressive, and dynamics happened to be very different. So I had to reassess what's going on. But it takes months of thinking and observing the markets to come up with a new paradigm.
So if we think of this city landscape, and we like treasuries, but you conceive of portfolios which they don't have quadrants, but which are orthogonal, if you will. What would be an appropriate sister holding if that is your central proposition? What would you add to the portfolio which would be a complement to that view, or would it be a risk cushion? Would you amplify that view with another asset class, or would you hedge that?
I'll give you an example. I'll give you an example. What I throw out there would be oil. Because having a long deferred oil would be a good complement, because if you really think about this, oil trades forward oil for delivery like 2-3 years from now is below where it trades now. And we all know that in the event of global growth, it's going to be very hard to have oil prices where they're now because of the structural supply problems, because there is not a lot of investment and the green replacement is not happening fast enough. So almost in every scenario except global deflationary recession, oil probably will do well over the next 3 years. Now, however, if global deflationary recession happens, I probably do well on my treasury bonds. That's how I'm thinking about it.
So you think that there's a scenario where you could make money on both sides,
Yes.
and there's a scenario with a lower probability, the blow up deflationary scenario, where yes, you would lose money in oil. You would at some point dynamically reduce risk on it, but you would have immense convexity on your treasuries.
Correct. And this is the type of structures I look for. This is this is my book, The Next Perfect Trade. If you look at the third part of this book where I talk about this like more advanced portfolio construction strategies, I'm looking for those situations. I'm looking for trade pairs in which you don't lose money on both of them.
Yeah.
So if one of them loses, then another one is very likely to succeed. But eventual goal is to make money on both of them.
Yeah, I mean, this is the orthodoxy of global macro. When you hear of this term, global macro hedge funds, this is kind of this is what we do. Yeah. Can you just tell me? I'm just curious, given that you offered the oil situation, is that the future discount to spot? Is it particularly notable? Is it a particularly large discount, or is an average discount?
I wouldn't say it's extreme. But in a situation, the great thing is that if overall you have that bullish view, and on top of it, basically, but it's significant that if you just hold it and it ends up 3 years from now where it is now, you get adequate return on capital.
Yeah, no, indeed. And I might say to those who follow me on Twitter or Instagram that I've been putting a few things out, trying to discuss gravity, like things change, a positive price trend might break, and then we might try and determine a mean reverting point. Because there is eventually a degree of price weakness where people will buy. And right. I was being non-scientific, and for me, there are extreme events where price indices will hit their 20-year very slow price moving average. I mean, Japan actually hit its 40-year, but let's leave Japan aside. And within that exercise, I did note that oil is actually kind of trading on its, can I say that, on its 20-year, is it trading on its 20-year price average? Does that sound right? I hear myself, I'm always doubting myself.
No, that sounds about right. I would probably imagine that's about right.
Yeah. And so you've got something which is already, it's gravitationally been pulled to its mean point, and then you're able to purchase it. How far out are you? 5 years, 3 years more?
I like to be out about 3 years, but I mean, that's a matter of taste where you want to be on this particular trade.
And you're buying it.
It's a matter of how fast you think radical changes in infrastructures and technologies could make oil obsolete, right? If you don't think it's going to happen in 5 years, you probably, like, this is a matter of opinion. I'm comfortable that it's not going to happen in 3 years.
I don't think we're going to see.
It's not going to happen in 10 years. I'm not, right?
Yeah. I don't think we'll see commercial fusion in 3 years.
But in 10 years, maybe.
Yeah, no, indeed. Indeed. No, I like that. I like that very much.
I don't know. Do you like the oil trade yourself? I mean, I don't know if you have any.
What I like about it is that the spot performance rather confirms the prejudice about rates, and oil's back on where it started the year, and it looks heavy. It's not indicative of an overheating economy or a booming economy, and so that kind of validates, in a sense, the holding of the treasury. I mean, my message this year has been: this is easy. Don't own stocks. Own lots of the ultra long bond. And like kind of put things in your ears. Don't listen to the Fed, and enjoy.
Yeah, I think for people who that is solid strategy. I
Yeah.
mean,
Yeah.
this is not what I'm doing for various reasons. I want to get a little higher returns, and I might choose the sectors of treasuries I like to be in. I choose to balance the portfolio, but I think in the end, yes, I think in the end, this is what I like about investment process, that sometimes you don't know at all what's going to happen in the next 6 months, but you can have a good idea what's going to happen in 2 years.
Yeah. Can I ask? I mean, you don't have to answer this, but do you think gold will break out? Will gold make a new price high?
I am in favor of precious going up, yes.
And do you have any solid um, analytical understanding for why that would happen?
No, just kind of historical pattern. I think with precious metals, the best way to just look how they historically trade and what historically happens, because you have thousands of years of history, so historical patterns are very good. One thing to remember with hard assets, be that oil or gold or real estate, if they are flat on price year on year and inflation was 7%, they actually cheapened up, right?
Yeah.
So I think that says gold is kind of ready to play the catch up. I think you also can I also like to look in terms of risk reward. Look at something like silver or platinum. They're like sitting around maybe 50% of the high points, give or take. And you're thinking, well, where will silver go? To zero? Probably not to zero. Can it triple in the next decade? Yes. So why is that not a good trade then?
Yeah. But for you, would you not? Can't you just reduce it all to a holding in gold, and the leverage or the lack of leverage will define the asset class? Like, so if you had like two and a
Yeah,
half
I
X,
have a bucket. I have a
silver.
precious bucket, but then I decide, for example, I can express my views through gold mining stocks or through other precious metals, but I look at like what it would look to me cheapest on a relative basis in that bucket.
Okay. Well, I am renting. I'm squatting. I'm squatting in my beautiful house, but I actually have clients arriving, and they do not want to find me in the. They don't want to find the asset capitalist in their bedroom. And so I'm going to have to, unfortunately, terminate this. And it's great because I can terminate with a tease, and it's great to tease it here because no one ever watches the last section of the show. But with your oil analogy, I was kind of thinking about Bitcoin, and I was thinking about an Ethereum, and I was thinking about buying these closed-end American funds, which are, so these asset classes again have mean reverted. And they haven't been around for 20 years, so we don't have a 20-year price average, but they've mean reverted hugely. And then you can actually buy, like your oil, you can buy an asset which is mean reverted, so it's become less risky. Yeah.
Right.
And then with you literally have the future shape in the discount to NAV embedded into the Grayscale trust and the Ethereum trust. And so something is mean reverted, and then you can buy it at like a 40% discount to the mean reverting point. Kind of like I don't have to be a crypto bull. I don't have to talk about blockchain. I kind of literally just have to buy it.
I'm aware and I'm sympathetic.
Yeah, great, wonderful. No one will ever hear that. This is wonderful. My friend, Alex, that was entertaining. I was disciplined. You were elegant in your demonstration of your knowledge. I hope we should do this again. And I'm going to cut this, or else I'll be introducing you to my clients.
Okay, well, very nice to be here. Thank you for the lively discussion.
Thank you. We'll be in touch. I'll let you go.